Hello, thank you for joining us for our quarterly market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strege. It has been another strong quarter for the stock market as the recovery from the recession caused by the pandemic continues. We're recording this about a week before the second quarter end, and so far the market represented by the S&P 500 index is up about 5% for the quarter and 12% year to date. Meanwhile, the bond market has also fared much better this quarter as interest rates have stabilized after a swift run-up in the first quarter. The Bloomberg Barclays U.S. Aggregate Bond Index is up nearly 2% for the quarter, although it is still down about 1.5% year to date. Over the last 40 years, it has taken an average of almost 4 years for the U.S. economy to fully recover from a recession. This time, it only took about 1 year to fully rebound, which is the fastest V-shaped recovery in history, according to Zacks Investment Research. The U.S. economy is among the leaders in the global recovery, with economic growth expected to be between 6 and 8% this year, which would be the highest annual growth since 1983, according to Schwab. While the current business cycle has been unique in the fact that it has been accelerated, it has been more normal in regards to the performance of the various sectors. The more value-oriented sectors, including energy, financials, and real estate, suffered the most last year during the recession, but have performed the best this year during the recovery, as they typically do. It is also worth noting that value stocks, those that are trading at lower prices relative to their earnings or assets, consistently outperform growth stocks over longer periods of time. Over 10-year rolling periods from 1926 to 2020, value stocks have outperformed growth stocks over 80% of the time, according to research by Dimensional Funds. That is why we tilt our portfolios towards value stocks over the long term, but will make adjustments through various phases of the economic cycle. Perhaps the biggest perceived risk to the economic recovery is excessive inflation. Investors have been rattled throughout the year by rising inflation, but luckily the market has recovered quickly after dropping. The Consumer Price Index has risen 5% since last May, according to the U.S. Bureau of Labor Statistics. Hopefully, you're not currently in the market to buy a car or build a house. Used car prices have increased 21% over the last year, and lumber prices have risen 400% from their low in 2020. Pent-up demand and short supplies have created the environment for inflation. But we believe that this surge will be relatively short-lived. The disruptions in the supply chain due to the pandemic, such as worker shortages, production facility closings, and shipping congestion, seem to be very slowly improving, and we think could return to more normal levels sometime next year. The surge in prices has reminded people of the high inflation of the 1970s. However, let's briefly review some trends that make it more unlikely the U.S. will revisit a long period of high inflation. First, demographics have changed. In the decade of the 70s, the ratio of young to middle-aged workers was at record high levels. With the baby boomer generation entering their prime working and spending years. This wave of young workers created high demand for goods and services that boosted inflation. While this young worker ratio is again climbing today as the millennial generation enters their spending years, it is not expected to be anywhere close to that of the 1970s and the baby boomer generation, all according to data from the Organization for Economic Cooperation and Development. Second, the labor market structure is different. In the 70s, unionization was much higher and workers had much stronger bargaining power than they do today. In addition, other changes such as globalization and technological advances have kept wage growth low. Companies have leveraged employees from around the world that have lower wages, or have implemented technology to replace employees altogether. While some growing political pressure exists to increase wages and lower income inequality, wages have a long way to climb to compare to the levels in the 70s relative to profits. Finally, government policy can influence inflation. When President Nixon took office in 1969, he was highly motivated to lift the economy out of a recession, and he steered government policy to be inflationary. He severed the dollar's ties to the gold standard, increased government spending, did not raise taxes, and pressured the Federal Reserve to keep interest rates low. In addition, tensions in the Middle East led to an oil embargo in 1973, which caused oil prices to skyrocket. This created the perfect storm for high inflation, which averaged over 7% annually during the decade of the 70s, all according to information from Schwab. There are some similarities to government policy today, with the Federal Reserve making a transparent decision to let inflation run hot for the time being as we come out of a recession. However, if inflation rises above their target for too long, the Federal Reserve has indicated they will take actions to control it, as Fed Chair Paul Volcker decided to finally do near the end of the 70s and end a decade of high inflation. Overall, we continue to be optimistic about the stock market for the second half of the year, although we do expect the rally to begin to slow down. The Fed has a difficult job conducting a balancing act between inflation and economic growth. Inflation is certainly something we will continue to monitor, but it is less of a concern if it is being driven higher by strong demand in the economy. The stock market is very forward-looking, and much of the expected economic recovery could already be factored into stock prices. While the performance of the various sectors of the market are continuously changing, our investment team will continue to evaluate which areas of the market look appealing. But as long as interest rates continue to be near record low levels and the economy and company profits continue to be near record high levels, we would expect the stock market rally to continue. Thank you for joining us for this quarter's market review and outlook. To our existing clients, thank you for your continued trust and confidence in us. If you are not a client, we would welcome the opportunity to review your investment portfolio and discuss your particular situation. Take care, and we will see you next quarter.